So on the ET Money Show, on the Money Show today, we make sure that we don't just talk about investing in mutual funds, but also help you meet the brain behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Ashutosh Bhargava, who is the fund manager and head equity research at Nippon India Mutual Fund, who will talk about Nippon India Balance Advantage Fund. Ashutosh, thank you so much for removing time today on the Money Show. It's lovely to have you, and we are going to focus on Nippon India Balance Advantage Fund. But because I have you on the show, it's important for me to ask you questions on the current crisis. Where do you think the story of SVB Bank is headed in terms of global crisis, in terms of impact on India?
So basically, as we all know, we are in the midst of very aggressive monetary tightening, and some kind of accident at some point of time could have happened. It's just that this issue has cropped up in the last 1 week and has taken everyone by surprise. Good thing here is that there has been a stopgate mechanism also in place by the Fed, and I think the big contagion crisis has been averted. As far as the impact on India is concerned, other than very short-term risk of kind of sentiment, I don't think there is much to read into it. In fact, on the positive side, there is one section of the market which believes that Fed may be perhaps less aggressive as far as rate tightening cycle is concerned. If that is the case, I think it's good for us also, because that would put lesser pressure on the RBI also to tighten further. And therefore, the resultant overall tightening would be lesser, which will be good for the growth in the second half of this the coming fiscal year and beyond. So I think so far, I think the big crises have been averted. But the lag impact of already done tightening will keep reflecting in slower growth in the quarters to come.
All right. In terms of US market now, where do you think the interest rate trajectory is headed, looking at this particular crisis and looking at the jobless claim data as well, and earlier the data that came on non-farm payrolls, etc. So do you still think the aggressive rate hike pace will be still maintained, or there could be a pause button that the Fed might want to press?
The personal take is the outcome would be somewhere in between. You might not see an immediate pause, because that goes completely against what Fed was saying till Wednesday to their Congress, for example, in terms of their intention to contain inflation going ahead. And after this crisis, obviously, there will be a recognition that a very aggressive tightening in a short period of time will have its impact in terms of solvency of institution, and some kind of credit event cannot be ruled out. Therefore, from what market was expecting just a week ago, that Fed will hike by 50 basis point going ahead, I think Fed might choose to hike by 25 basis point, and thereon will become more data dependent to see the fallout of that this event in terms of overall financial condition, overall lending growth, or if there is any impact on job market. So the pace of tightening will certainly come down, but I don't expect that just because of this event and what the response, some kind of QE response which Fed has already delivered, they would want to pause at this juncture. I think they will continue, but at a perhaps much lesser aggressive pace than anticipated.
Mm-hmm. And where is the rate hike story headed for us? Because in terms of triggers, if we look at monsoon, and so far the reports that are claiming that monsoon is not going to be something that we all would want it to be, that is going to be a major trigger for us. But apart from that, in terms of rate hikes, you think RBI can afford to take a pause at this particular juncture?
Maybe there's a need to tighten a little bit more because inflation has been coming higher than expected. And still at this point of time, it's not, the debate is not settled whether Fed is going to tighten or not. I think that another 25 basis point rate hike by the RBI is very likely, given where the inflation is clocking above 6.5%. And if that is the case, then beyond that, I think RBI would perhaps look for both the development as far as how the heat wave goes and the monsoon prediction goes, and obviously the overall global development of this, particularly from fallout from this crisis, or what Fed communicates on the 22nd of this month. I think that would shape up if there's more rate hikes beyond this 25 basis point, which I expect would most likely happen in April.
One last question on Silicon Valley Bank. What is the actual takeaway if we really want to analyze this particular fallout in terms of a learning lesson for the financial sector? What would that be?
Uh, the lesson is that, whenever central banks tighten, there are casualties. There's always be some pain taken by someone or the else. We have always focused more on the credit side or any credit event. The balance sheets are good, but it turned out to be more of a liquidity event or solvency kind of event for banks. So the lesson here is that to everyone to focus on their own risk management. This is not an easy period even for the central bank. The forecasting is extremely difficult. So having a very straitjacket opinion about how you want to run your finances or your portfolios, I think some openness about the possible developments which will happen over the shorter period of time. That nimbleness, that openness about changing the course is very much required, and more and more focus would come in terms of looking at the overall risk to your portfolios. That I would think after this crisis, I think beyond that, I don't think it's something where our regulators or policymakers have to do anything about it. I think we are in a very good shape. Our regulations are, uh, you know, very much best in class. So I don't think there is any need to change anything here. But yes, global risk off always have an impact on flows and certain sectors. So those kind of risk, as far as portfolio construction is concerned, we need to take into account going ahead.
All right, so that's the takeaway from this current situation. But then let's talk about Nippon India Balance Advantage Fund, and that's the highlight of our segment called Meet Your Fund Manager, where we help viewers meet the fund manager who's actually handling their money and investing it on their behalf. So I really want to start with the current asset allocation that you have in terms of equity, debt, and cash. What's the current exposure ratios?
So basically, between equity and debt, which are it's an equity-oriented scheme, but as the name suggests, the advantage is you can go below 65% in terms of hedging, right? Which you do. The net equity at this point of time, we are running around 40 to 43%. The reason being that, as we all know, valuations are on the slightly higher side. And it's a the way we run it, we look at valuation and some other tactical short-term parameters like price momentum, the behavior of currencies and commodities. Uh, all of these indicators are suggesting that this is not a time to be overweight on equities and either on the valuation side or from a trend perspective. So we are definitely running currently net equity allocation, which is below average. We run between 30 to 80%. And today, as I said, we are around 40 to 43% net equity.
How is the allocation distributed within equity in terms of sector preferences and weightage, Ashutosh?
So as a house, and even for this portfolio, we think that domestic-oriented sectors are relatively in better shape and place. This is where our overweight lies in sector like banking, where we are overweight, or domestic cyclical sectors like retail, autos, and some bit of capital goods. We've recently added little bit of utilities as well, which we think within the defensive sectors offers a decent combination of reasonable valuation and least of the growth downside. So these are our overweights, and as far as underweight are concerned, slight underweight in staples and IT.
Uh, in coming quarters, the kind of sectors that you just mentioned, especially the sector that you're holding on to, what kind of earnings are you expecting? Because we got a slight hint of the earnings in the last season that we got, that the coming forward time will not be that excited, or we muted earnings can be reported. So what is your view on these lines, especially for the sectors that you are holding on to right now?
So you're right. I think the entire focus from our side is on where there is a least of an earning risk. And that's why we think there's less of an earning risk to domestic oriented sectors. Take, for example, banks. Yes, banks have underperformed, but they have underperformed despite earnings upgrade. In fact, last quarter or last 1 year, you've seen the maximum heavy lifting as far as upward earning revision are concerned via banks. And there we don't see much risk as far as credit cost is concerned, or there are concerns about margins, which I think these concerns are overstated. Some bit of credit growth is already in the price. So 13-14%, which the consensus expect banks to deliver in FY24, I think this is something which is very much achievable. In terms of other sectors like cap goods, we know that the order books are strong. The margins have surprised on the upside. This is another sector where we have seen pretty broad-based kind of earnings upgrade. As I said, that within consumer-oriented sectors, we are being selective. There we know that high-end kind of consumption has held up much better versus the low-end or middle-income kind of consumption. So hotels, hospitals, these are the segments where earnings are coming good and the outlook of earnings remain strong. So this is where we are positioned. And lastly, as I said, utilities, uh, again, these stocks have come under pressure, particularly on the private utility side. But this is despite last 2-3 quarters of sustained earnings upgrade. And these stocks remain cheap on historical valuation perspective. So a combination of sectors where there is a reasonable earnings and not deviating from our overall largely value oriented style is what we are expressing in this fund and perhaps most of our funds.
Mm-hmm. Ashutosh, within banking and financials, PSU or private, what's your bet on, and what are the triggers that you are following here?
So we don't have any particular preferences about PSU or private. It's just that we are more focusing more on which are the banks which are very solid liabilities franchise. So yes, a lot of these private sector bank and one or two public sector banks offers that combination of very strong, liability side franchise, decent deposit base, which means that future growth is taken care of, good overall capital adequacy, high provisions. So we are choosing banks over NBFCs in general, and within banks, larger banks, which we think at this point of the cycle are get to be in a much better situation versus the smaller banks, whichever with slightly weaker liability base.
Let's talk about the debt side of the portfolio of this fund. What is the kind of strategy that seems to be playing out right now?
So as a rule, what we from the very beginning of the inception of this fund, 2018, we run this fund, the debt portion of this fund, like we run our short-term debt funds, wherein we don't take undue duration risk here or undue credit risk. So typically, the blended duration is lower than 3 years for this particular fund. And the credit quality is concerned, we typically invest around 80-85% of our holdings are investment grade in nature. So what we look forward from the debt portion is to provide very solid anchor without taking any risk. All the risk or alpha that we need to generate is through uh, proper signaling which comes from our own model. and the stock selection, sector selection we do on the equity side.
Right. So currently, what kind of an advantage do you think an investor has by placing their bets on a fund like this that invests in equity as well as in debt? And right now, considerable amount of exposure has been allotted to the debt side. What is exactly the benefit over here for say a short to medium term investor, or maybe even a long term investor, if both scenarios you could explain?
See, it goes without saying that forecasting is becoming very difficult if you go last 1, 2, 3, 4, 5 years. Um, so, you know, having an asset allocation based on some time-tested factors always helps, right? That is one thing which every every individual investor tries to have that right allocation for the right kind of market environment. So this is where our model helps. Um, at this point of time, when volatility is high and valuations are not in your favor, equity allocations are low. But if the situation changes, wherein we see a more favorable environment for valuation, either because of price correction or time correction, or we also see some positive development, positive trends emerging as far as currency market is concerned, interest rate market is concerned, commodities market is concerned, then obviously this net equity allocation, which is 40 to 43% today, can go up to 80%. So at the right time, there is a possibility, and that's what we believe, that model would indicate increasing the equity allocation at the right time, which investors don't have to do it themselves, because doing it themselves becoming difficult in an environment where there are so many uncertainties around, so many upside and downside risks, which we have seen in the market. So this is the job which a good robust, all-round diversified model does for you. And as but particularly for risk averse and new investors, which have not seen a cycle, exposing them to the market with, the nature of the market is volatile, then it becomes difficult because it increases the stress which comes with equity investing. So to have returns point of stress in a more superior manner, I think these kind of offering offer tremendous value. And this is what it can offer to new investor, conservative investor, or even for long-term investor. It can become a core part of the portfolio around which a mature investor can, increase their equity allocation on their own over and above this core allocation.
Uh, if we talk about balanced advantage fund category, and if you want to compare with a multi-asset allocation fund, Ashutosh, so there was a time when BAF were in vogue. Okay, people were just lapping onto it. There were returns in the funds also. But now, when we compare this particular category with a multi-asset allocator, the latter ones really seems to be performing well, not only in terms of their performance as a fund, but also in terms of investor interest. A lot of it goes to the AMCs also, who are really marketing well for the multi-asset allocator funds. But then what's exactly the reason behind the difference in the performance as well?
So one or two things basically, and BAF would always be an equity oriented fund, right? Debt will be limited to maximum 30-35%, right? In as multi-asset fund or these asset allocator funds, investors have an advantage of choosing more than two asset classes. You can invest in international equity, you can invest in commodities. Certain fund houses would also offer some thematic strategies, right, within the overall portfolio. So you can have a broad variety of asset classes, and you can also, within an asset class, diversify into, for example, in our asset allocator, the model chooses between large allocation in large cap, mid cap, and small cap, right? So intra asset uh, class, that kind of allocation is also possible, and that is another level of alpha which you can generate over and above, what BAF can offer. BAF can only offer the two asset classes, and equity will always be a dominant one there. Here, if for some reason, if local markets are not doing well and commodities like gold or international equities are doing well, that level of diversification is possible and available to the investors. So it comes with slightly more complexity, but also provides potential for more diversification and more, perhaps slightly better risk-adjusted returns.
Sure. Last question to you, Ashutosh, which will be on mid cap and small cap. Are you sensing pain ahead in these categories?
So if I just look at what our models are indicating within the equity allocations, um, um, it is indicating that 50% of the allocation is in large cap, slightly more than 50. So whatever equity allocation more than 50%, the model is favoring large cap, and mid and small cap put together is less than 50%. So clearly, it's not about valuation, but the other factors as far as the interest rate tightening goes, or the signals which we are getting from commodities or currencies, or the price momentum of market breadth itself, uh, are bit against mid and small cap category at this point of time. But from a slightly longer term perspective, I think the broader market valuations have corrected more than the large caps. So incrementally, maybe going ahead, um, gradually one can think about increasing allocation mid and small cap. But at this point of time, the weight of evidence favors large cap over mid and small caps.
Ashutosh, time to wind up the discussion, but then just last one thing, word of caution to the investors, viewers who are watching you right now.
To our viewers, we would say that this is not a time to really panic, but this is also not a time to be very aggressive as far as equity allocations are concerned. Uh, it's a cliched thing to say, spread out your equity allocation, have a scattered infusion of in equities, and that's what we would advise. This is an environment where if someone is continuing with SIP and continue with staggered allocation, the results will be very good on the other side when the dust settles after, say, 6-12 months. You will not be disappointed. And I personally believe that equity still offers the best chance for you to deliver real returns over the medium to long term. So don't forget that thing, and continue with your asset allocation, and be systematic as much as possible.
Sure. Ashutosh, thank you so much for being on the show today, and thank you so much for talking on the fund and also the market movement currently, which is very concerning for all the investors. Thank you so much.
Thanks for having me. Thank you.